The Finance Act 2020, taken into effect from January 1st, 2021, has introduced amendments to several tax laws such as the Capital Gains Tax Act, Companies Income Tax Act, Industrial Development Income Tax Relief Act, Personal Income Tax Act, Customs and Excise Tariff, Value Added Tax Act, Stamp Duty Act, Federal Land Revenue Service Establishment Act, amongst others. The Finance Act 2020 has clarified some gray areas regarding the taxation of individuals, introduced by some changes to broaden the tax net, cut back on generous personal reliefs, while granting the exemption from tax to the most vulnerable employees by exempting minimum wage from tax. As the 2022 Appropriation Bill awaits passage at the National Assembly, President Muhammadu Buhari had on December 2nd transmitted to the House of Representatives the 2021 Finance Bill, seeking speedy passage of the bill to support the implementation of the 16.3 trillion naira proposed budget. Well, I introduced them earlier. He is the partner tax reporting and strategy, PricewaterhouseCoopers, Mr. Kenneth Erikume. He joins me now via Zoom. Good afternoon, Mr. Erikume.
Good afternoon, Tolu, and thanks for having me today.
Yes, and thank you. It's the first time on the show. We appreciate this.
Thank you.
All right, January to December cycle is what I will first say. Many say the timing looks very good. Our budgeting is now following that timing and to make us plan better. But some are saying it's even better because it comes with the Finance Bill. Finance Act. Let me call it an act. Now, tell us, what really is the relationship between both documents?
Right. So you would have noticed that this current administration towards the end of 2019 sought to revitalize the Finance Bill process. And what that essentially is, similar to what you have in other countries, is that they pass fiscal changes to align and drive the budget. So essentially, what that simply is, when you're looking at a corporate, is that a corporate has a corporate strategy and has a budget for the year. But, to drive that, they need to now look at how the numbers will work out. So that's essentially the principle of using the Finance Bill as an enabler for the government to fund the budget. So, previously, our laws were very old and archaic. However, the needs of government, and in order to be able to respond to the demand from citizens, the tax laws were not being updated as quickly as, trends in terms of the economy were happening. So, when the Ministry of Finance opted to start running the Finance Bill process again, it was a welcome development, not just for the public sector, but even for the private sector. Because what it meant is that the laws will then be updated to, first of all, drive the core revenue generation for government to meet its obligations in the next year. But in addition, it also ensured that the laws were fit for purpose and, they were actually changing in line with current trends. So, in this current 2022 appropriation proposal, what is being proposed is about 16.39 trillion in terms of expenditure. But in terms of revenue generation, it's about 10.1 trillion naira. That gives a budget deficit of above 6 trillion naira. And then you need to ask yourself as government, how are we going to fund that deficit? And how are we going to meet, the revenue projections? And that's where the Finance Bill comes in. The Finance Bill, you would notice in this current, the Finance Bill 2021, which will become the Finance Act 2021, a lot of focus is being made at revenue generation, as against what you saw in the previous years, where there were, a lot of reliefs granted to small and medium companies. The focus this year is largely on revenue generation and to drive the ability of the tax authorities to continue to generate that revenue. So that's simply what the finance bill process is and how it ties to the budget.
Brilliant way to start this discussion. 16.3 trillion naira. That's a lot of money from where we're coming from. I think we're doing about 13 points earlier. So like you said, and many have said, that the Finance Act is to aid government, you know, in sourcing these funds and all of that. Then many would think that there is another way to overtax people or maybe increase the tax burden, while some would say, why not just try to expand the present net and make sure that everyone is paying? So where do we draw that line? We know what is happening across the country, and when we have to pay more, Nigerians would not want that to happen. So how do we draw that line in raising revenue for government and not hitting hard on the masses?
So there are two ways of, actually maybe three ways and more, of increasing revenue in order to meet the budget. The first way is to actually look at new sources of revenue in terms of the revenue streams. And what government has done over the past couple of years is to look at some sectors that they were previously not generating any revenue from or any significant revenue from, particularly the digital economy, where, you know, foreign digital companies have customers in Nigeria, but because they are not operating out of Nigeria, there is no nexus or trigger point for the government to tax them. And secondly, not just from an income tax perspective, but also from an indirect tax perspective, you know, you're actually procuring some of these products and services, but because a lot of them are in a B2C business model, government is unable to actually collect VAT on those transactions. So one of the things that the government did, you know, in the past couple of years was to introduce new digital focused tax regimes that would, you know, generate more revenue from that sector. So you can look at new income streams from new sectors. The second one, which a lot of us have been clamoring for, is actually the expansion of the local tax net. And this is important because, you know, when Nigeria rebased the GDP, we began to see that our tax to GDP ratio is one of the lowest in the world amongst countries that impose income tax on corporate and individuals in the country. So the, you know, that 6% tax to GDP ratio is too low. It means that there's a lot of economic activity from which government is not able to generate revenue. So in order to plug that gap from a government perspective and also ensure that there's equity in the system, and what I mean by equity is that every single taxpayer that has a responsibility and an obligation, they are all remitting their fair share of taxes to government coffers. So government needs to expand the tax net in order to deal with that. And that would include, you know, new taxpayer identification to bring them into the tax net and plugging every gap in relation to tax evasion. And once they're able to do that, I think some of the issues we're having from a tax to GDP ratio perspective will be dealt with. And, you know, the importance of this one, these first two which I've mentioned, the first one which is looking at new sectors of the economy to tax, and the second one which is to look at new taxpayers to tax, The issue is that, or it's not an issue, the advantage of doing that is that it's not going to increase the burden on already existing taxpayers who are contributing their fair share to the tax pool. The third bit, which is the one which is sort of like a concern for everyone, is when government increases revenue through taxing the people who are already in the tax net. To be fair to the government, they have not introduced any new taxes that I'm aware of. So the taxes as they were, capital gains tax, companies income tax, and so on, they are just as they were. But some tweaks have happened. For example, previously in Nigeria, there was no capital gains tax on the disposal of shares, and that made Nigeria a very attractive destination for equity investment. So what that essentially means is that an investor could come in, incubate a business over time, and exit that business and make a lot of gains through capital appreciation. And once they made that gain through disposal of shares, they were not going to be taxed historically. Now, what this new Finance Bill 2021 proposes is that going forward, it introduces a new rate of 5% on the disposal of shares where the proceeds are of 500 million naira and above. So through that, there is a new introduction of tax obligation, but not a new introduction of a tax liability. And it's not too onerous from a Nigerian perspective, because there are examples from other countries as well as even African countries where disposal of shares is actually liable to capital gains tax. And it also ensures that it plugs some loophole in terms of companies who are not distributing dividends, but they just leave those dividends in retained earnings, and then in the future they dispose of the shares. So I think that is the one. You could do it in one of the ways which government has done it, by looking at an area where you can introduce taxes but not essentially new, but then there's the other one of the impact on the economy. And I'll talk about this one because there's the bit around the digital services tax, and you would have seen in the press the comments saying that individuals will now need to pay more for consumption of digital products from foreign entities. So when you're streaming music or streaming videos or paying for adverts on those platforms, they will now be 7.5% more expensive than before, because VAT will now be collected by the foreign digital service company. So those are some of the things government can do to ensure, I think the first two, to ensure that citizens are not paying more. But overall, because the budget is a deficit, you will see some new introductions like the CGT, which I mentioned, and the VAT on digital products.
Let's wrap it up this way. This finance bill, of course, like you alluded to, is to help reposition finance system and plug wastages. How well are we also taking advantage of technology in actualizing this? Talking about our tax system now.
Yes. So interestingly, one of the things that government is trying to do is to enable the FRS in particular, because the amendments were to the FRS Establishment Act, to strengthen them in terms of usage of technology. In the past couple of finance acts, there was already an introduction that the FRS can use technology, can deploy technology for tax administration and deploy technology for monitoring the income of foreign digital service companies, but also deploy proprietary technology to monitor the income of taxpayers within the shores of Nigeria, which is what we call fiscalization, you know, when we're talking about that in the tax industry, where government plugs fiscal devices or plugs a software to the point of sale of businesses to ensure that they're able to read what the revenue is and be able to have some intelligence around, you know, how much VAT they should be paying and how much income tax they should be paying. What I would want to see in the future, because it's not just about putting the laws to use technology, is a more robust digital strategy, you know, by the government. So it's one thing to amend the laws, but it's another thing to then ensure that there is a robust digital strategy which has taken the input of stakeholders, particularly businesses. Because what we've seen in the industry is that many times these technologies are deployed, but sometimes they are not user friendly, and at other times they are not reducing the burden of tax administration for the taxpayer. For example, with Tax Pro Max, for example, taxpayers have had to go and revalidate their withholding tax credit balances from the old platform which the FRS was using and go and try to revalidate it in the new platform. You know, and with that, a lot of back and forth with the tax authorities just to ensure that that is validated. It takes a lot of time, it takes a lot of energy, and remember, taxpayers had gone through that process once and now they have to go through it again. And then in addition to that, there are also issues with the user friendliness of the company's income tax module of Tax Pro Max. So we want to see a more robust, you know, tax technology strategy by the tax administration and more stakeholders engagement. So with the VAT automation, for example, the fiscalization which I spoke about, in other countries, what the government does is that they exempt you from a tax audit if you have already plugged into that plan. So some of these things we would like to see them in the future.
Amos, thank you so much. I've been speaking to Mr. Kenneth Erikume. He is a partner, tax reporting and strategy at PricewaterhouseCoopers. Thank you so much. I really do enjoy the rest of your day, and a Merry Christmas in advance.
Thank you, Tolu. Thanks for having me again. Looking forward to the next time.
All right, then.